Hello and welcome to Business on the Wire. India officially entered a technical recession last week. Provisional estimates of GDP for the second quarter show that economic output shrank by 7.5%, following the almost 24% contraction in the first quarter. The economy shrank for a second consecutive quarter, marking a recession, a technical recession, for the first time in independent India's history. However, many economists were quick to point out that the number was much better than was feared. Things are looking up economically speaking, and the Reserve Bank is now projecting a GDP growth of 0.1% in Q3. Where does the truth lie? Joining me to talk about that is Dr. Shankar Acharya, noted economist and former chief economic advisor. Thank you, Dr. Acharya, for joining in and speaking with me. Here we are with 2 quarters of what people term a technical recession, and it's brought us at an interesting crossroad where there's half the economist population that says this is a really, really dire situation for the Indian economy, and there's the other half that read this negative 7.5% tick and said things are looking much better. We're all set for a sharp rebound. Where does the truth lie?
When you have kind of half and half, I'm not sure, by the way, it's half and half. I think as far as independent economists are concerned, there's a very clear majority which says it's a bad scene in terms of what's happened to GDP. But I think there is more of a divergence in terms of the nature of the recovery. And I think there is not much, you can't argue with what the data are. And the data, as you know, to get back to basics, is that because of COVID and the associated lockdown, you had Q1 of this fiscal year, GDP declining or falling by an unprecedented 24%. And since you ask, I was one of the few people who, way back in May, long before anybody else was doing this, projected that probably you'll get a GDP decline of between 25 and 30% in the Q1 of this year. At that time, in fact, quite a few people were still projecting positive growth for the full year. So it seemed to be quite out of the question. And so, Q1, therefore, we know now from the NSO data was 24%. And all of us who kind of said, look, that's very deep. We also said that that's going to be the worst time because, basically the lockdown ceased, or at least got largely softened from June onwards. So economic activity could recover pretty sharply in the second quarter, that is Q2. And there the debate, I think there wasn't much debate. The question was whether it would be 8% or 12% negative compared to the previous year. And it turned out to be closer to the 8%. So that's a good thing. But it's not such a big variation when you think about it. Yeah. I think the real issue is now looking forward. That is what's going to happen to Q3 and Q4. And there I think you are now once again seeing divergence. You had divergence way back in May when a lot of people were very sanguine about the cost to GDP. Some of us, like myself, said it'll be very high, and we were right. Then you had a period of, yes, of course, there's going to be a recovery in Q2, which is what happened. And now, when it comes to Q3 and Q4, you're seeing divergence again. Because, as you know, in terms of the official sources, both the Ministry of Finance and the RBI are predicting that we'll be in positive territory year on year in Q3 and Q4. Now, I should point out that both these organizations, if you look back just 1 year, were pretty wrong when it came to what happened in 2019-20. That as late as June, July last year, they were saying, oh, it's going to be around 7% growth in 2019-20. Some of us disputed that. And I think we turned out to be right because, as you know, what happened in 2019-20 was we got growth around, GDP growth around 4%. So at least the recent track record of Finance Ministry and RBI on short-term growth projections has not been very good. But that said, What are they projecting? They're essentially projecting a tiny bit of positivity in both Q3 and Q4. I think it's 0.1, taking the RBI one, which is much more precise in terms of what they laid out. They're saying it's going to be 0.1% positive in Q3, and I think 0.7% in Q4. So if you take an average for the 2 quarters and think of it as half a year, it's like 0.4% for the second half of the year, positive. Now, as against that, I haven't looked to see what all the analysts are doing. My own view, if I can offer that to you, Mitali, is that we are probably still going to be in negative territory in both Q3 and Q4. So in that sense, there's a clear divergence of what I think at today versus what Finance Ministry and RBI are saying in the last week. I would say that we'll be, if you take it as a half year rather than quarter by quarter, that is Q3, Q4 together, instead of the plus 0.4% that the official authorities are saying, I would say it's going to be more like negative 2 to 4% for the full half year, the latter half of the fiscal year. Now, I don't want to make too much of it because that's not a huge gap. Considering we were down to minus 24%, if one party is now saying, oh, we'll be about 0.5% up, and another party is now saying, well, we'll be maybe 3% down, it's not such a big gap, but it is a distinct gap.
Let me ask you this then, Dr. Acharya, for someone who's watching and perhaps doesn't quite get the intricacies of the data that we're discussing. Is it a possibility that we continue to see some kind of recovery on that GDP tick that we watch, even as the labor market continues to worsen and the informal sector of the economy continues to actually get worse rather than better? Can there be two distinctly diverse paths that they take over the next few quarters?
Oh, definitely, Mitali, definitely. I'll tell you why. I mean, one simple thing is, it's the base issue. You see, I mean, even if the labor market, which you rightly focus on, and we can say, spend a little more time on it later, even if the labor market situation is bad, the recovery next year, which is sort of the 4 quarters, shall we say, beyond Q3, Q4, in my view, in output terms, is going to be very strong. Because if you've had I mean, just think of it in terms of arithmetic. If you went down minus 24, 25% in Q1 of this year, and you're somewhere near the levels you were at the end of last year, by Q1 or Q2 of next year, that is, 21, 22, I guess, you're going to have a massive rebound in that quarter. I mean, you'll have something like, again, that 24% will become, instead of being minus, will become positive, and indeed it'll be a higher number positive because you're on a lower base if you're getting back to the same level. So, if you went down minus 24% in Q1 of this year, you may well be up by minus 26, 27, 28% in Q1 or Q2 of next year. So in that sense, I think next year, that is when we are talking about 21-22, fiscal 21-22, to my mind, is clearly going to show what looks like amazingly good growth figures. But you just have to remember that this is just a rebound. It's like, if we are near to the levels we were in 2019-20, you've recovered from the V, if you like, and that's what's showing the growth. It doesn't tell you anything, in my view, or not much anyway, about what's going to happen after 22, and that's the key. In other words, it will. In fact, here's my prediction for full year growth. Full year growth this year, RBI I think is saying it's going to be 7.5%. Am I right?
Yeah.
Minus 7.5%. Yeah, I think it's going to be more like minus 9 to 10%, but that's not a big issue. Let's assume it's minus 9 to 10% this year. I would say that next year you'll see something like plus 10%, maybe 11%, because of the same kind of pure arithmetic recovery. And in the RBI's case, because they have a lower decline, -7.5, maybe you get 8, 8.5 or 9, I don't know. So that part is, I don't think, the problem. However, that doesn't tell you very much about what's going to happen to employment in the coming year. Hopefully it'll be a bit better, naturally. It should be. And B, most importantly, it doesn't tell you what's going to happen beyond next year. That is beyond FY 21-22. And that's the real worry of those like me who think that, because of things like the overhang of a large public government debt problem, large deficits and so on that we have inevitably run this year, because of our continuing very weak financial sector, stressed by many ways, because of our protectionist trade policies and a variety of other factors, that it's going to be very difficult for growth to be, say, above 5%. Whereas that's where the bulls, if you like, say, oh, no, it's going to be back to 6, 7, 8%.
There's actually a report out most recently by Oxford economics, Dr. Acharya, that talks not about 5%, but 4.5%. And they go on to say in no uncertain terms that this looks like the medium-term trajectory for India, as also that the post-COVID-19 scars could be amongst the worst in the world for India. Do you concur with that opinion?
Broadly, I concur, Mitali. In fact, going back as far back as June of this year, I had made this point in one of my articles. I don't know if you read my articles, that growth in the 5 years after FY 21-22, that is, would be probably in the order of 3 to 5%. So if you want to take the halfway line, that's 4%. So that's very close to the Oxford Analytica number, and certainly, not worth saying it's different. And I said that, I repeated that in, I think, an article in September, that again, for a whole set of factors I kind of listed, I expected growth to be, no one can be certain. The future is uncertain. So, please leave me the liberty of revising my views in future. But at this point in time, I think if you're talking about medium-term growth beyond FY 21-22, that is, usually we think of 5 years as the medium term, then it's more likely to average, I think, between 3 to 5 rather than, let's say, 7, 8 or 6, 7.
What kind of consequences does a 3 to 5% tick hold for employment in India for a country our size, Dr. Acharya? And I just want to sort of, layer that question with an observation that was made even in the data that came in this quarter, which is that a large part of why you saw corporates doing better was the intense cost purging that included large-scale layoffs. That's going to cause a major mismatch, of course, in the labor market. But even in the longer term, 3% for a country this size has implications for our labor force, does it not?
It has a negative implications for a lot of things, but let's focus on the labor force because I think that's really, in my view, the most important. And by the way, don't say I said 3%, I said 3 to 5%.
You said 3 to 5.
Just because I'm of age, don't put me down at the bottom end of it.
Be mindful of it.
This is all gazing. I'll say that straight away. Anyway, our labor market story is very bad if you look at what data we had for the last 3 or 4 years. As you know, the NSS sample surveys, the last one a few years back was 2011-12. Then there was a 6-year gap. And we had that one in 2017-18, which was held up for a few months and then released, if you recall. And that was only released last year. That is in 2019 calendar. And that showed that, our labor market situation was already very dire. And this is the NSS data. That is, if you take things like labor participation rates, they were down below 50%, which had never been the case before. And if I remember correctly, that and this was a very, very bad number, that the female participation rate in the labor force was down to about 23% compared to 43 or something 7 years before that. And the point I'm trying to get across is even before COVID and all that, 2017-18 data that we had from the NSS showed a very weak situation. And you had the other key number I often cite is that unemployment rates amongst youth was in the order of, if I remember, about 17-18% or something. I'm speaking from memory, so I may not be exactly right, but very high. And so, the whole set of numbers which came out in 2017-18 NSS data that are very disquieting and very worrying. And I wrote about it at that time in 2019, last year, when they came out. Now, since then, of course, the other thing that has become quite useful as a data source, as you know, is the CMI surveys as part of their consumer pyramid surveys or whatever they call it. The CMI has been doing a fairly large sample, I think, if I remember right, over a 4-month period. They do these, it's a panel data, so they keep going back to the same set of households. And that has shown, again, a significant drop in all these things like the labor force participation rate and also the unemployment rate has tended to fluctuate. But I think what they had focused on is the employment rate, which for your viewers, let me clarify what that is. That is nothing more than those employed divided by the working age population. In the total population, there's a certain working age population, and that's got nothing to do with the market condition. That's a fact of the demography. So that it basically says, who are out of say total population of 1.3 billion or whatever, what is the number which is in the age group 15 plus to 65 sometimes, or sometimes they just say 15 plus. And what I always roughly remember is that the working age population in India in the last couple of years has been around 1 billion, okay? Whereas employment levels have been more in the range of 400 to 450 million by the CMI data, which is a bit different from the NSS data. And what that means is well under half of those in the working age population have jobs of some kind, any kind, informal, formal, everything. And what's particularly worrying from the CMI data, because the great thing about the CMI data is they're doing it all the time. So you get weekly slices at it, you get monthly slices at the stuff, and so on. All these things like participation rate, employment rate, so on. And what that shows is the employment rate has come down from somewhere like around 43% in 2016-17, okay, to during this COVID year, if I may call it that. At one time it was in Q1, it was down to 30% or thereabouts. That's a huge drop. And I think even Q2, it had just got to still below 38%. So if you compare 43 and 38, that's still a 5% drop over 3 years in roughly the same source. And 5% is 50 million people out of 1 billion, right? So we are talking about a very weak labor market situation as of Q2. Now, I can't tell you about the future yet, but it's going to be a very, very uphill battle to get the labor market conditions to be anywhere near acceptable.
Two things then, Dr. Acharya. How do you see demand trending over the next couple of quarters? And the other sort of oddball has been the way a lot of people have approached inflation. It's been rising since April and it's still termed as being transitory. Even in its most recent note, the Reserve Bank said we hope for the winter months to ease this off. But this is clearly above and beyond their own comfort zone. What do you make of the inflation trajectory, and what do you think demand will look like for the next few quarters if your view is that growth will trend the way that you just described?
Well, I mean, growth is essentially telling you something about the output, right? And output is, of course, is a result of both supply and demand, and you can have problems on either or both. And I think demand will be a problem. It has been a problem. It will be a problem. Just as supply was the big problem in the first half of this year because of lockdown, essentially. If you're not allowed to produce, then you're not getting supply. It's as simple as that. But I think that consideration is gradually waning because, we are into unlockdown for the last few months now. And so that problem it's not gone away. It's still there, but it's much less. A factor which affects both on the side of demand and supply, which I like to stress, and that is still, I think, continuing in particularly service sectors of the economy, and as you know, services are a big part of our economy, is risk aversion, especially amongst consumers, but even amongst producers, because they have to take special steps, distancing, this, that, and all those things, which raise their costs. So, risk aversion, because of the fact that the pandemic is still around us very much, and is likely to be for another few months and perhaps longer than that, because the vaccinations it takes a long time to vaccinate 1 billion people plus. So bearing all that in mind, I think that's continuing to be a factor. So, but broadly, the supply constraints will loosen, are loosening, which has allowed the kind of recovery we've got. Demand is going up also. Some of it is pent-up demand, as people point out. But I think as we look not to quarters, but more for a year or 2 years ahead, demand is going to be a problem when you break it up into its major components, which are, as you know, consumption, investment, government, and exports. And I think all of those are going to be somewhat muted in terms of their growth as we look ahead. Not again next year. Next year is going to be the rebound year, so forget that. But beyond that, they're going to be muted for much the same reasons that supply has been. And I mean, think about consumption. You have to have incomes also growing, which means you have to have outputs also growing at a rapid rate. A 4% growth or a 5% growth economy is not going to be giving you huge dollops of additional income to households and so forth. And therefore, you can't expect consumption to really boom. Against that background, investment in many sectors may be also subdued. And when you think about exports, for example, which at one time was 25% of our economy, but now is at both goods and services, but now is well below 20%. That's also likely to stay muted, partly because the world economy is likely to be growing slower, and partly because we are into what I regard as the wrong set of trade policies in terms of being protectionist, not joining RCEP and things like that. So I think that's going to be a problem.
Specifically on exports, Dr. Acharya, do you think enough time and attention is being paid to the situation? As you pointed out, I think even in November, exports are down about 9%. As you said, we are out of RCEP, or at least we are bystanders on RCEP. Is this going to be a bit of an albatross around the Indian government's neck?
Which one, exports or RCEP?
Well, the fact that they are falling and the fact that we don't seem to be part of any of the pacts.
Yeah, I think exports is a real problem, big problem, but it's not just because of what's happened this year and COVID and so forth. I think it's been a problem now since, in my view, since around 2012. So it cuts across two governments, actually. If you go back to the data and you look at particularly the merchandise export side, goods exports, they've stagnated sort of in dollar terms, roughly around 300 billion, plus or minus 20, since then, which is not just terrible, but it is bad, and it's very different from what was happening before, for the decade before that, when exports were booming. If you go back between 2003 and 2011-12, exports of goods were booming. Post 2012, as I mentioned, it sort of stagnated even before this COVID further hit. And that, I think, some people say, oh well, world trade came to a bit of sharp slowdown after 2012. There is something to that. I go along with that. But a lot of countries have managed to continue with high export growth by increasing their share of world exports. If you look at Vietnam, if you look at even Bangladesh, China, of course, their share of world exports during this slow world trade growth period has continued to rise. India's has not. India's has stagnated. And therefore, people say that, well, it's all to do with world trade growth. World trade has grown slowly, so we have our exports have stagnated. But that's, I think, only half the story. The other half is not enough attention has been paid to exports. We've had a number of problems. First, we had problems of going back in the decade of overvalued exchange rates, of our exchange rate being overvalued for competitiveness reasons. And of course, we have all the problems of infrastructure and issues of land acquisition, this, that, and the other, factor market problems. But the other problem, very much has been that in the last 3 years, I would say, that our trade policies with respect to things like tariffs and so forth have become protectionist. And what people forget, they think many people think, oh, import duty falls on the other country, but that's just not true. I mean, it basically affects the incentives in our home country, and what it does is it not only discourages imports of certain products where the tariffs are raised, but it essentially makes it harder for our exports to flourish. Because when you put a tariff on, let's say, steel or some other input coming in from overseas, it means prices go up. And so whoever's making exports out of, let's say, steel as an example, finds the input costs have gone up, so they're not unable to compete in global markets. And at a broader level, a strategy of rising protection in terms of rising average tariffs on imports means that you're making the home market your focus and making it more profitable than the export or the world market. So that, from an entrepreneur's point of view, it's easier to make money in the domestic market than to work hard at making money in the export market. So for these sets of reasons, I think in the last 3 years, the impact of our trade policy is also being felt. And yes, there has been the COVID effect, of course, but I think that is a lot to do with what's happened in the whole world economy, as well as our own production. And that part, I think, can recover. I mean, exports being 9% lower in the last month or quarter or whatever you're referring to, that can be recovered. But that's not going to be enough, because what we need to do is basically the share of export demand out of GDP has to get back to where we were 8 or 9 years ago, which was 25% at least.
Are you hopeful that India might turn around with its trade policy given the current global political environment, Dr. Acharya? Because even with RCEP, there were some criticisms regarding the fact that it wasn't pro-environment and pro-worker enough. The tariff cuts demanded weren't large enough. Is there another elegant solution that presents itself for India, or do we have a bit of a pickle of a situation with exports for some time to come, you reckon?
Well, I think if we follow what policies that I don't regard as the right ones, as I've just outlined, then we have a problem, and that we can't blame that on others. That's our problem. And until we correct those, whether it's to do with overall protectionist tendencies or whether non-participation on RCEP, and those are two separate things to some extent, though they interact, it's going to hurt our trade outcomes, including on exports, which we badly need to regenerate. So now, is it likely that something will happen? Frankly, I'm not sure. I mean, this protectionist tendency part, which I date back to roughly 2017-18, I think the budget that raised import tariffs across the board quite a lot, and it's ever since been repeated, was Mr. Jaitley's 2018 February budget. From then on, I think we've very much, so we're talking about 2018, 19, and 20 now, which is almost over. We've had this problem. And once you get this sort of trend working, all sorts of lobbies and vested interests grow, which say, no, everybody's doing tariff increases in the rest of the world, even if they're not. This is really something India also has to do, and therefore we should do more of it. So it gets harder and harder for the system, including the political executive, to get out of that trend. So that's why I'm not hugely optimistic that our trade policies will suddenly change gear overnight. I certainly hope and pray that, say, in the forthcoming budget a month or two from now, they're not raised again, import tariffs. But I have no way of course, saying that it won't happen. And on RCEP, we all know the story that, at one time a year ago, it seemed to be touch and go. I mean, people were almost about to say, well, we are in. And then the news came that we were not. And there, I think my thought would be that, of course, every regional trade agreement has pluses and minuses. But my thought would be that, look, RCEP refers to, if you think RCEP is just a bunch of letters, a short form of Regional Comprehensive Economic Partnership. But the key is that it's an Asian grouping centered on the ASEAN countries. Yeah. And the key point, if you notice, is that this is the part of the world which is recovering fastest post-COVID. Or COVID hasn't gone away, but post the COVID meltdown. And if you look at Europe, looking pretty sick still. If you look at America, not so good. So if you look at the big groupings, NAFTA on one side, EEC on the other, and RCEP, RCEP countries look pretty good in comparison. So if we are denying ourselves the kind of market access to RCEP that entry would have given us, we pay the cost.
I want to shift focus to a more here and now topic of discussion. You've been non-executive chairman of Kotak Mahindra Bank for many years, so you understand this space well. And there is currently a debate raging on whether or not corporates should be allowed or denied banking licenses. Most recently, the finance minister alluded to, the Lakshmi Vilas Bank episode and said it's a sign the sector is opening up. But you've not been in support of this idea, have you, of allowing corporates to enter the banking space and give them banking licenses?
Well, I think here, if you took a poll of sort of independent economists, it won't be 50-50. It'll be more like 90-10.
I think if you took a poll of the working group itself, it was 90-10, sir. There was just one person who was
not the working group. I think it's the expert group they consulted.
Expert group, sorry.
Yeah, I don't know what the views of I think the report of the internal working group of the RBI, the IWG as it's called, as far as I recall, said that they consulted, 7 or 8 quote unquote experts. I'm not sure who they were, but I think only one favored opening up to industrial. So I think you'll find a similar kind of ratio if you took independent trade economists that you wish to speak of. Not trade, finance economists. And I think the reasons are in my mind, reasons that everybody's known for a long time, and why, in a way, if you go back in history, one of the reasons, and I emphasize it was only one, that nationalization happened of banks in 1969, well before you were born, is that I think, I'm not sure, is that there was this business of industrial houses having partial ownership of banks at that private bank. This was all in the private sector. And there was lots of what's called connected lending. The bank lends to the same enterprises from the same group which owns them. That's the big problem. And now with nationalization, of course, it went away. Banks became public sector banks. Since then, of course, a lot of things have changed and we don't have time to go over all of that. But I think the reason why economists like me, like Dr. Kedkar and Arvind Subramaniam, we all wrote a joint article in Express, which quite a few people have read, are worried. And Raghuram Rajan, I think, and Viral Acharya also have made public statements. Why we all worry about industrial houses being allowed entry into banking is that you have again the phenomenon of large-scale connected lending. Now, why is that an issue, you might ask? After all, capital comes in, you have more banks, more competition. Well, the problem there is, I think there are three main problems. First, connected lending tends to mean that banks owned by the particular industrial house, shall we say, lend to enterprises for projects which may be a bit borderline risky, and more so than if it was an arm's length borrowing lending decision. So there is a situation where essentially bad loans are more likely to happen once you get a proper look at those loans afterwards. Secondly, it also means the problem of exit, which has been a problem for us. That's one reason why this IBC came in, bankruptcy code, and which is a little bit now kind of run into some problems. But the whole point there was that when an industrial house was having problems, or when some of its firms were having problems, that instead of, as in, if you like, the textbook situation where you close the enterprise, somebody buys it at a lower price and does something else with it, and it gets back into productive use, it becomes a sort of zombie enterprise and continues to live with subsidies and all sorts of special favors and tax reliefs and this and that. So that problem of exit will be compounded by connected lending, because industrial houses which have such enterprises will have the power and the means to channel bank funds to them, right? And the third big problem, so it will delay what's called desirable exit of poor enterprises from activities. Now, the third big problem is that it will lead to more concentration of economic and other power in the Indian economy and society. I mean, as you well know, I don't have to give a list of these. There are half a dozen very big conglomerates in the Indian economy. I mean, you can rattle them off much easier than I do. You follow these things. And I don't think that's a healthy form of what's called capitalism. You want more competition. You want less,
concentration.
Where you want wealth to be spread across many more enterprises than is apparently the case in today's India. And that problem will get compounded because the most powerful industrial houses are going to be the ones which will probably get bank licenses because they're well connected under the new zamana, if it's allowed to happen. So I think those are major reasons why one doesn't want to go down that road.
One final question to you, Dr. Acharya. You were chief economic advisor for a very, very long period. You've watched India go through several crises, including the global financial crisis. Are you somewhat dismayed when you look at what's happened over this 10-year period? We've gone from 10% plus growth in 2010 to here we are in a COVID world, admittedly, at minus 10% in 2020. And it's not just these 2 quarters. It's been happening for the last 12 quarters, the kind of growth pinch that we're feeling. How do you sit back and sort of make sense of this?
Well, first of all, I stopped being a chief economic advisor back in early 2001, so it was a long time ago. I'm a pretty ancient person. So I don't have any insider information after 2001, but I've stayed engaged, as you know, by being a column writer and writing books and stuff like that. Now, I think from the decade between 2000, I think let me put it this way. Here's an answer which may or may not satisfy you. I think our best period for the economy's functioning, as well as the economy's our economic policy, was between roughly 1991, the big reforms in the early 90s, if you recall, up to 2004 when it comes to policy. But in terms of outcomes, which is what you're focusing on in a way, I think outcomes continued to be good all the way till, as you said, 2010, 11, the global financial crisis part. Because, economic reforms are not a switch which you put on and next day something fires. These take time to work themselves through the system. And even after economic policy ceases to improve, the system may continue to work pretty well for a few years, which is, I think, what happened, say, between 2004 onwards. Until 2009 or so, you continue to have high growth in India. Some would say until 10, 11 perhaps. And after the global financial crisis and our own sort of policy hiatus and all those scams of the early 2010s, growth seemed to go away. Since then, it fluctuated for a while, up and down. But if you take the broader picture, essentially you came down from being sort of in the 8% range growth annually. If you go back to those years, in growth terms, the best years were 2003 to 2010 or so, or 11. To the most recent years, for example, it's come down. Leave COVID aside, that only came this year, March. Even before that, we were down to 4% by 2019-20. So a fall from 8% to 4% is a huge fall. Now, maybe you can argue that 4% that year were special factors, I don't know. But it's certainly not a good story in these last decade.
No, it is not. But I so appreciate your time and thoughts today, Dr. Acharya. It's been an absolute pleasure speaking with you. Thank you very much for joining in and speaking with me.
Thank you, Mitali. Let's hope for better times.